finally, face to face, Luke Smith, financial planner at Envision Financial. And there you were, luxuriating in the Gold Coast last week, you know, having Mai Tais on the sandy beach of the Gold Coast. Now you're back at work, which is good to see.
There was no sand, there was no beach, there was no Mai Tai, there was lots of rain, and I sat in a boardroom for 3 days.
Wonderful. Drinking coffee out of plastic cups.
It was lovely, exactly.
And you can contact Luke Smith and his good team at Envision Financial at 4452 Townsend Street, Phillip, 62604749. But if you have something more urgent to talk to him about today, you can do it on 6255 1206. PSS, and I'm not being rude.
PSS, exactly right.
Yeah.
So one of the defined benefit schemes issued by the government. So
okay.
Public
Service Super.
Public Service Super, that's right. So the government have always had a couple of defined benefit schemes. It started with the CSS, then it turned into the PSS. The PSS is now a closed fund, so people that are in, and they have a standard accumulation fund for new members.
When you say it's closed, what does that mean?
So it's shut to new entrants.
Is that right?
Yeah, it shut approximately, don't quote me, 2005.
Really? So if you join the public service now, you can't get in this?
Correct, that's right.
So what do you do?
Well, you end up, they just have another fund that is a standard accumulation fund, whereas this is a defined benefit scheme. So this fund has its characteristics of this fund are very, very different. So it's not your standard accumulation fund, it's not your standard industry fund or anything like that. It has its own rules, its own regs, its own calculation methodology, and we're going to sort of run through some of the key points today.
So if you were in public service before 2005,
yep.
you've got triumphant super.
Yeah, look, I find this quite interesting because a lot of people come in and say, I'm in the PSS. Now, as a fund, very, very generous, and you know something's very generous because the government closed it. That's how generous it is.
Yeah, okay.
It's that good, they shut it.
What the government giveth, the government taketh away.
Correct, that's right. So the PSS is the defined benefit scheme that works out your entitlements over your working life with a formula. And it has to do with your final average salary and the rate of contribution that you put into the fund over your working life. Now that's called your accrued benefit multiple, or ABM. So for example, if I'm making a 10% contribution to the fund, my accrued benefit multiple after 10 years of service is 0.31. And you add up all your 0.31s, and when you finish and you say, right, I'm off, time to retire, you take your final average salary, you multiply it by your accrued benefit multiple, and that's how they work out the capital value of your membership. And then there are a range of different ways that you can access that benefit, depending on your situation, your other assets, what you need to retire on, etc., etc. So it's very different to what people would think of as a standard accumulation fund, where you put in your money, you remit the tax to the ATO, and then you invest what's left. There is a component of that in the fund, but it is very, very different because of the way that it's an actuarial calculation to work out your accumulated wealth.
What sort of superannuation rate was it?
Well, it's not so much the rate, it's the way that the contributions that you make over your working life are valued, measured, and then used to work out what your entitlement is. So basically, the greater your contribution over your working life, the greater your accrued benefit multiple. And obviously, the higher your final average salary, so they use final average salary in the last 3 years, multiplied by your accrued benefit multiple, which is a measure of your rate of contribution over your years of membership. You multiply your final average salary by your accrued benefit multiple, and it gives you X.
Right.
And X is the number that you're working with to then say, do I want to take a lump sum? Do I want to take a full pension? So you can actually convert the lump sum to a full pension income stream, or a combination of the two, where you convert at least 50% of your lump sum as a pension. You could take the balance as a lump sum. So you can have $500,000. So let's say you had $1 million, keep it around. You've got $1 million in the fund after the calculation's been worked out. You have the option to take that $1 million out as cash, and there'll be a taxable component in there. You also have the option to convert that $1 million into an income stream.
Right. That would depend on your age, yes?
Exactly right. So that's one of the other key benefits and real values of this fund, is what they call the pension conversion factor. And that is the number that is set in the rules of the fund, that depending on your age, is the way that the pension is calculated. Okay?
Yeah.
So if you've got $1 million in the fund and your pension conversion factor is 10, you end up with a $100,000 pension. Okay? You also have the option to say, well, I'll take 50% of my lump sum, or $500,000 as a cashable amount, and I'll convert the balance as an income stream as well. So there are a lot of flexibilities in the rules, and it's really important that people understand their options, because doing what your friends did may not be the right thing for you.
As we all said, what do you want?
Correct, exactly.
And Luke Smith, would it also depend if you want to suddenly pay off your house, because that's not paid off at the moment, or buy a car or go on holidays?
Look, 100%, and this is where I think understanding the rules and the benefits of the options that you have, people should also take into account not only any liabilities they want to extinguish, but potentially estate planning controls. Do I want to give the kids something? Do I want to pass something out to them? Do I have business interests? Am I or am I not going to go back to work? That's another really big one, because the tax-free pension rules that most people assume from 60 everything's tax-free don't necessarily apply to the way this benefit is calculated. There is a component that is tax-free, and that is the amount of money that the member has put in themselves over their working life. That comes back as a tax-free component. But there's also the employer portion of the benefit that can be taxed and untaxed. So I won't get too far into that today, because that gets a little technical, but it's important to understand that people need to think about what they're going to do in retirement. Will they or will they not return to work? Because if you took a full pension, you could actually be buying yourself a tax problem. You could have a $50,000, $60,000, $70,000 pension, go back to work and get a $100,000 job. Now you could be paying a significant amount of income tax. So thinking about your why and saying, okay, why am I retiring? Why am I taking my benefits this way? Can ensure that you maximise the flexibility, not just now, but in the future, because you may change your mind and go back to work. You may contract. You may be an employee. You may not go back at all. You may have assets from other resources in your name that could increase the amount of tax you pay. So it's important to understand that people need to make the most of their membership, because the fund is very, very generous. So I'd recommend, if you can afford a 10% contribution, really, really think about it, because it will increase your accrued benefit multiple at the maximum rate, and that is very, very beneficial. Think about other contribution options around your PSS membership. So think about making a personal deductible contribution. Think about salary sacrifice, and maximising the way that you accumulate wealth outside of the PSS for added flexibility.
Does it all come back to what you want? What are you looking forward
to?
Look, 100%. Tomorrow,
100%.
How are you going to fix up tomorrow?
Yeah, and the other thing that people need to be mindful of with the PSS is obviously the introduction of the transfer balance cap. Okay, now the transfer balance cap is $1.6 million, and it's the maximum amount of money that you can have in super and draw a tax-free pension. Now, this is really important, because the value of an income stream from the PSS is counted towards your transfer balance cap. So if you leave on a $50,000 pension, you multiply 50,000 by 16, you end up with 800 grand. So there's half of your transfer balance cap gone. So if you've got money outside of super, you then now to start to take into account things like super splitting with a spouse, withdrawal and recontribution strategies. So, as we say, if you start stacking some of these considerations on top of each other, and one strategy stacks into the next and into the next and into the next, there's some really powerful benefits available to those that think ahead and actually know, well, what am I likely to do? How do I want to maximise my income? And what's the best thing I'm going to need going forward?
There you go. Luke Smith, financial planner at Envision Financial. We are trawling over PSS. The pitfalls, the tricks, and the acronym of the week are still to come. And you can contact Envision at 4452 Townsend Street, Phillip. They're upstairs, down the end of the street, 62604748 at 4:45. With Luke Smith, financial planner. The good team at Envision Financial, you can call them 62604749, PSS as they say, a generous scheme. Somebody decided to set it up and then the government said, oops, we shouldn't have done that, let's shut this down in 2005. Just very quickly, you said it went from the CSS to the PSS.
Yeah, so originally there was the CSS scheme, and then they invited members to move over if they wanted to. They, as I understand it, they didn't have to.
Right.
And then if you were employed after a certain point in time, you became a PSS member. And then, I say, when they shut that fund around 2005, I think it was, don't hold me to that, they then said, right, any new members go into now the PSS AP, which is a accumulation plan, which is more of a standard fund, like everybody else would know at home.
There you go. And the CSS money's still sitting there, isn't it?
Yeah, CSS members still contribute, that fund still operates.
Is that right?
They just couldn't add new members from a certain point in time.
Oops again, 2 oopses in a row, not
Two
bad, I
oopses.
tell you. What do you see the missed opportunities with this?
Yeah, look, I think a lot of people do what their friends did.
Oh, yeah.
You know, a lot of people come in and
that way,
a lot of people come in and say, well, I'm going to do this because, and they don't really have a good idea why. So understanding the best way to get your best outcome is important. Thinking about obviously what they're going to do. So as I said before, a lot of people take a full pension and then go out and get another job for a similar level of income and have potentially fairly large tax problems. So people need to make the most of the estate planning benefits of this fund, and also look at a combination potentially of taking a part pension and then starting a tax-free pension with the lump sum, depending on their age. So you can keep a lot of that in super tax-free, and also not thinking about the impacts of the transfer balance cap. A lot of people get caught and are penalised tax-wise on money outside of the PSS because they've taken a big pension thinking that looks great, when they could have potentially generated a similar level of after-tax income with a combination of part pension and lump sum that starts another income stream. So that's really, really important. It's important that people stay while they're working and meet an anniversary of a birthday, because that's when you get indexation applied on your membership benefits on salaries and things of that nature.
Where does the financial year fit into this scheme? Does it fit in anywhere?
Oh, look, it's really the measurement for the fund is done on your birthday date, when certain things, indexation rates are applied. So it's important to take that into account, and also to know what your strategies are around the PSS. So you can be a member of the PSS and they now record part of your contribution or your membership against the deductible limit of 25,000. We find a lot of people think that they can't add to their own super fund outside of that and miss out on good accumulation and tax deduction strategies over their working life. So having a combination of the two, both being a PSS member and outside of the PSS, is really important, because they can make sure that they can save efficiently for retirement, max out that $25,000 contribution cap, and then stack that strategy with other things like super splitting and account-based pensions off the back of it.
Pile it up.
Yeah, look,
pancakes.
Exactly right. If you start stacking up the strategies these days, they really start to get some control and some momentum. You know, we'll touch on that in a sec.
Yeah. So when you've got this the opportunity set in place, can you nibble at this money that's sitting there, or you've got to take?
No. So a member of the PSS is stuck in the PSS, if you like. It's a nice place to be stuck, because there are very few other things you can do. For example, you can't trigger a transition to retirement strategy being a PSS member. Okay, it's just the way the rules of the fund are written. It's not available with the way that the benefit is calculated, unlike the CSS, which had that flexibility in certain situations. So I think going forwards, trying to stack up some of the strategies that we speak about each week. If you're a PSS member, look at making a personal deductible contribution each year up to your concessional cap of 25,000, and members can go into the website and actually look at their concessional cap space on the website. It's a really, really good feature that they've got.
Top it up.
Yep, they can look in and say, right, my PSS membership it records $10,000 towards my $25,000 cap, so they know they've got $15,000 where they could make deductible contributions to super to further bring down their taxable income.
And that's the aim, isn't it? To bring down as much tax.
Well, exactly right. If you're trying to accumulate leading into retirement, you want to try and do it as tax efficiently as possible. So that's a really big one. Putting contributions in your own name and then looking to split those to a spouse. If you've married well, you can pass accumulated superannuation outside of the PSS to the older spouse, which could bring forward your access date. So that's a really, really powerful one. And looking at the part pension and the lump sum option, and looking at the tax-free options of passing some of that lump sum money to a spouse, so that you're potentially not in excess of the transfer balance cap. So taking those long-term views is really, really important. And obviously then there's the benefit of withdrawal and recontribution strategies to try and maximise the tax-free portion of any money outside of the PSS. So make the most of PSS, get your 10% contribution in, and then look to try and bring the balance of your personal contributions up to 25,000 and look at it as a unit. because if we start stacking these strategies on top of access to offset accounts, personal deductible contributions to limit your income tax, tax-free payments into super to try and draw income streams, and having a PSS pension and a tax-free account-based pension running together can give you access to money for holidays, cars, trips overseas, because the PSS pension is effectively like another income stream. It comes every fortnight, you don't have access to the lump sum, and it just rolls into your bank account on an ongoing basis.
It comes back, Luke Smith does it every week. We talk about planning. Why do you want something?
Oh, look,
Where's
it's
going?
exactly right, and I think people need to understand that the biggest one we see missed is especially the pension between 50% and 100%. A lot of the generic paperwork that gets spat out in the reporting says, here's 100, here's 50, here's a lump sum. It doesn't detail very clearly the difference between 50, 60, 70, 80, 90%. You've actually got to go and work that out or ask for it yourself.
Yeah.
And I think people are quite surprised when they come in and say, well, why don't you take 7%? For
Hang
this
on,
reason.
No, I could.
Exactly
Yeah.
right.
Yeah.
So
Ask.
understanding the options is important, because once you make your decision,
Done.
you can't go back.
Yeah.
So it's a one-time gig, and if you get it wrong now, you've got it wrong for the next 15, 20, 25 years of your life.
Acronym of the week, ABM, accrued benefit multiple.
That's right. So that's one of the key components in calculating the PSS benefit. It's just how your personal contribution and your employer contribution is measured each year.
Okay, so there we go. And of course you can get all of this very easily, can't you, Luke?
Yeah, look, we do. We've got the podcast now on Apple, the Strategy Stacker, Luke Talking Money. Client actually came up with that name. I thought it was
Luke Talking
quite
Money.
ingenious.
The
Strategy Stacker.
It doesn't work out as a word. No.
We've got the footage of the shows from an educational standpoint with the key takeouts on YouTube. So that's Envision Financial Canberra.
That means you can freeze frame, go back.
You can freeze frame and go back, and we've got all the bullets in there about the key takeouts we talk about on the show. And obviously you can go and delve into the technical world of calculators and those sorts of things on the Resource Centre. That's at www.envisionfinancial.com.au. Click the Resources tab and then go down to the Knowledge Centre. You can subscribe there and get access to a library of technical information, calculators and all of that for free. And that's available to all of our listeners as well.
Of course, we're on podcast as well.
Yep, podcast, that's right. So, that goes up every week, and they can listen to our dulcet tones in the car as they drive home. And
because these sort of things aren't easy in half an hour to explain.
No,
Sometimes you miss the point. You really, what was that about? I want to hear that again.
And that's where we came up with, a client said once, well, why don't you record it so I can skip back and see. So we put halfway through the show now on YouTube, we've got all of the key takeouts. And as I said to a client this afternoon, we'll call her Karen to change her name. She only started putting a 10% contribution into PSS just recently after 18 years of membership, and you should have saw her head sort of sink against the table when she found out what that was worth over the longer term. So you don't know what you don't know. Sometimes that can be quite expensive.
And if you'd like a face-on-face first appointment, no obligation, half an hour for free, 6260-4749. It's Luke Smith, financial planner at Envision Financial. Go to all the websites. You can do the YouTube, you can go on a podcast, envisionfinancial.com.au, Resource Centre, web access, it's all there, it's all available. And you can see them and have a cup of coffee, 4452 Townsend Street in Phillip. Give them a call, make an appointment, doesn't cost anything but the phone call, no obligation, 6260-4749. We will see you in a week.
See you next week.